I'm just going to share my screen. Hopefully everybody can see that okay. Yeah, great. So first off, I thank you for the invitation, because as I was saying to Scott at the beginning, this is a paper from a project that has lain dormant for quite a while. And most of my work actually is on political economy. I'm a comparative political economist, and I do a lot of work on international political economy as well. But a couple of years ago, with two friends and co-authors, Nina Wiese-Homeyer and Chris Arnold, we did begin a project which was interested in trying to explore, or at least trying to map out the positions of Latin American presidents and executives through their speeches. So we wanted to explore whether we could use speech data as a way to get an insight into the types of positions and preferences that Latin American presidents express, and how they might use this speech data and how they might use their speeches as a way to manage all sorts of different aspects of their governance. And so we were particularly interested in how they might manage legislative coalitions, or how they might manage coalition partners by using speeches and by using signals and by intimating compromise. So that was the motivation behind the project itself. This built on, Nina had done a lot of work, which is interested and still is involved in a large-scale project, which uses expert survey data to try and assess the positions of Latin American presidents. And Chris was very much the technical point person on this project, driving it forward. So a lot of the innovations in the paper and in the larger project itself, I have to say, were not my doing, and I must give full credit to Chris for developing a lot of the technical side of the project. So the project itself, we began a couple of years ago, actually quite a few years ago now, really at this stage, and various aspects of life got in the way, children, moving countries, moving house, COVID, all sorts of things that happen in one's life. And so some aspects of this project stalled. And we did have one big paper that was based on the speeches that was published in a poli-sci journal. We have a couple of small pieces, and this was one of the last papers, or it was the last paper that we decided to do with this project and with this data. But it has lain dormant for quite a while, and so I'm very thankful to Scott and Anna, because what they have done is given us the energy to go back and revisit this paper, and we're in the process of rewriting it, and we're hoping going to send it back out again soon, and finally, as it were, get it off our desk. So as I said, the motivation for this project stemmed from the different types of speeches that we noticed or that we observed, or the different ways in which Latin American executives gave speeches across the region. This man in the bottom right-hand corner, and some of you may recognize, is Hugo Chavez. Hugo Chavez became very famous for a very long TV program on Sunday morning called Allo Presidente, which could sometimes last 5-6 hours. And this TV show was incredibly informative in terms of setting out the government's agenda for the week. It would often give a very clear indication as to where the government stood in terms of international foreign policy, but also domestic issues. And often, actually, it was a pretty good signal of quick changes or very snappy changes that the government would adopt with response to policy. And this contrasted to the speeches of this person here, is Michelle Bachelet, who's here actually giving a talk a couple of weeks ago, the Chilean president, or the former Chilean president, currently United Nations High Commissioner, who was trained as a doctor, who would give speeches that were very consensus-based, that were very measured, and that were quite centrist in a way. And in comparison to these two, this is Carlos Menem and this is Enrique Pena Nieto, which were very different in style and tone. And so we began thinking a little bit about whether these types of differences in speeches, whether they actually meant anything. So is there anything that we can infer, or is there anything that we can take from these different types of speeches that these presidents would give, and the different types of messages that they would deliver in these speeches? And when we began this project, a lot of people would push back and would suggest, well, surely, speeches are fairly empty rhetoric, or at least speeches are empty vessels. What really matters is policy. But one of the things I think that certainly the position that we developed over time was that these speeches matter, so that these speeches are quite important, and that these speeches, particularly coming from executives in contexts where there's high levels of political uncertainty, where parties often don't take very clear and identifiable spatial positions, that within these contexts of uncertainty, that these speeches can be strong signals both to their own governing partners, to the legislature in a wider sense, to the general public, but also as well to other international actors, most notably economic actors. And that's really what we wanted to focus on in this particular paper. In the larger project, we were quite interested in exploring how these speeches somehow would map on to particular preferences or positions that presidents would adopt, and why they might change these positions and preferences, and how they would use these signals as a means to manage different aspects of their own coalition or different aspects of their or even of their own governing party. So this particular aspect of the project deviated from those initial papers, which were focused on how they use these signals to manage internal governance effectively. And we began to explore how these speeches might be used as an economic signal. And we think speeches are really important as an economic signal in the context of Latin America for a number of reasons. The first of this is that capital and access to capital is really crucial for Latin American governments to a far greater extent, or at least the nature in which Latin American economies have been structurally inserted into the global economy has meant that these economies are very dependent on securing access to international capital. So capital is a really crucial means for these governments to smooth consumption cycles, to try and offset some of the negative effects or deleterious effects of economic downturn. But it's particularly difficult for these governments to attract reasonably cheap credit and capital, primarily because capital tends to be pro-cyclical. So capital flows to the region tends to be pro-cyclical. Now, what I mean by that is quite simple. What this means is that when times are good, capital flows into the region because investments and returns are great. And so we see a big upsurge in government's ability to access credit and just to access and use capital. But in contrast, when times are bad, capital tends to flee the region, and it tends to go to the safer havens, or what it perceives to be the safer climates of Norway, of Switzerland, of German bonds, for example, and Canada, Australia. And so what this means is that when these governments are facing a downturn in the business cycle, so when they are facing some type of economic downturn, when they most need capital and they most need access to credit, it becomes much harder for them to access this capital and credit and to do so at a reasonably healthy interest rate, because capital tends to be pro-cyclical. It moves with the cycle. And so this has really significant consequences for these economies, because if we think about an economic crisis, when an economic crisis hits and we think about society, society is a little like a slinky, that children's toy that's like it's an elasticated piece of spring. And so when a crisis hits, the slinky, the income spectrum, will begin to fall. And in many countries in the world, or at least in many of the advanced industrial democracies within the world, they are able to place some type of safety net under that slinky to prevent it from hitting the floor. So this is what we call compensation. This is what social welfare does, and it prevents your income spectrum from becoming far too stretched. And this is what means, or this is what manages the levels of inequality within your society. It prevents inequality from becoming too stretched. The furlough program, the government support schemes that we see in the United States and all over Europe and in the UK in particular, are classic examples of this type of compensatory safety net in the event of some type of crisis to prevent the slinky from becoming too stretched. For Latin American governments, the pro-cyclical nature of capital means it's very difficult to do this, because when a crisis hits, the slinky begins to stretch, but it's either much more expensive to access capital or much harder to access capital and credit. And so this really undermines the ability of these governments to invest in the economy when spending is most needed. And so as a result, boom, this slinky falls to a much greater degree. And so we end up having this exacerbated effect on levels of inequality in the event of a crisis. And partly this is a product of this pro-cyclicality of capital. This is exacerbated by the fact that many of these economies already have low levels of domestic savings. And since the early 1980s and the reform of their economies, at least in South America, most of these economies have become primary commodity exporters. And so both the pro-cyclicality of capital and their dependence on the export of commodities, demand for which, of course, is going to come from elsewhere. So Latin America enjoyed a huge commodity boom throughout the 2000s, mostly driven by very large levels of Chinese demand for Latin American commodities. This means that these economies are then very vulnerable to shocks and exogenous shocks, so falls in demand for their commodities. which drives down the business cycle, which in turn forces capital to leave and has this reinforcing effect in generating these really severe types of economic crises. Oh, yeah. And we have quite a bit of work which is focused on how these crises have generated policy switches. And there's some really well documented policy switches in the Latin American context. So the picture of Carlos Menem that I put up earlier, he is renowned for running on a campaign advocating nationalist, statist economic policies, but then once in power, implementing and overseeing one of the most radical economic reform programs that the region has seen. And within the space of 2 years, he had significantly altered the structure of the Argentine economy, completely belying the campaign promises that he had previously made. And so we have a lot of work which examines how the severity of these shocks forced Latin American governments into quite radical policy switches, what became known as the bait and switch presidencies. So they would bait the electorate with promises of the status quo, but once in power, they would then move away from the status quo and implement quite radical economic reform. So, and we have examples of this, for example, in Fernando Collor in Brazil and Carlos Menem, Alberto Fujimori in Peru, etc. But we were less interested in policy switching, and given the context of our project and this focus on speech, we were quite interested, well, given our understanding of the importance of speech, well, how then might Latin American governments try and manage and signal to the expectations of international capital owners? Because when a crisis hits, trying to manage the expectations and perceptions of capital can become really important. And speech, we suggest, is a crucial way in which these presidents actually try to achieve this signal. So they're trying to send competency signals to capital to try and convince capital not to leave the jurisdiction, to try and gain access to cheaper credit, to try and convince capital to stay within the region. And so this brings us to the central argument that we make here. And I think it's probably less of an argument and more of a broad intuitive suggestion, I would suggest. And it really starts from this shift in the power of capital that we have observed across the region following the collapse of ISI. ISI was a model of economic development known as import substitution industrialization, which was adopted largely across the region, certainly among the larger countries within the region, following the Wall Street crisis in 1929, which forced many of these countries to experience a big trade shock, but also a huge shortage of imports. So they began the process of industrializing and trying to develop their own nascent indigenous industrial sectors. And in some countries, their industrial sectors were really, really large. So in Argentina, in Brazil, for example, the state had a really significant and large presence in the productive economy. But with the collapse of ISI, beginning in the late 1970s and culminating in the debt crisis of the early 1980s and the debt defaults of 1982, we began to see the structural reform of these Latin American economies. They had to address high levels of debt. Some of these countries were grappling with hyperinflation. And so this meant they engaged in quite significant structural reform. So they increased the flexibility of their labor markets. They removed tariff barriers. They began the process of making capital markets, or removing capital controls and making capital markets much more open and much more fluid. And also this structural adjustment saw many of these countries engage in widespread privatization of their industrial sectors. Some industrial sectors remain, but they are heavily subsidized by the state and perhaps not that competitive in an open market sense. And also, we saw, particularly in South America, it was a little different in Mexico and in Central America, but in South America, many of these countries were reverting back to a form of primary commodity exporting, which had been the kind of dominant economic model between about 1870 and 1929. And as I said, this model of commodity exporting makes these countries very dependent on demand from elsewhere, and also makes them very vulnerable to any type of external shock. And as I did briefly discuss, we've got quite a bit of work focuses on the effects of this vulnerability. So we've worked highlighting the bait and switch presidencies in response to significant economic crises, work by Danny Campello and Sue Stokes. And Steve Kaplan has talked about cycles of austerity and how this is related to the different types of creditors that these governments are reliant upon. We have work from Eric Wibbles and Moises Archie, which talks about how the openness to the global economy forces down tax burdens and also reduces spending. And we even have some recent work by Danny Campello and Cesar Zucco, which talks about how the dependence on the international economy is driving a misattribution in political outcomes. And So this economic dependence is then further magnified by the centrality of economic voting. I know this is an interdisciplinary seminar, but in political science, we have some key models of voting behavior. One is what we might call a sociological perspective, which is really based on long-term development of parties and how we become socialized into supporting these parties. The other is what we call a Downesian or spatial perspective, which is the more ideological form of voting, where the voter places themselves on an ideological map and parties place themselves on an ideological, and parties use their labels as heuristics to enable voters to place them on this map also. But in the Latin American context, because party systems are so unstable, because party brands change so often, neither the Downesian model of voting nor the sociological model of voting are really possible. So the only rational incentive that large swathes of the electorate have is to vote on the basis of the economy. So that is, you're rewarding incumbents when economic voting, when economic performance is good, and you punish them when economic performance is bad. And so as a result, economic crises can be politically existential, obviously, particularly in times of crisis, slightly tautological there, but yes, economic crises can be politically existential within the region. So these crises become crucial events for politicians and executives across the region to try and manage. And when it comes to crises, the region can face two major types of crises, are broadly defined. The first is what we might call exchange market pressure, and the second is credit market pressure. Exchange market pressure just happens when you have some type of depletion of a country's international reserves or a sharp devaluation of their currency. And often this is driven by some trade shock. So this even means that an export-led recovery is just not possible. And also capital flows tend to react to these types of shocks. And so capital tends to leave when we see these depletions or devaluations in the country's currency. A credit market pressure is just simply caused by a rise in the cost of credit for these countries, when either bond or bank-based lending just becomes more expensive, often in conjunction with some type of economic downturn, which increases risk or the perception of risk, and which gives rise or causes this big shift or increase in the cost of accessing credit. But structural reforms, which we know are an important way to deal with this crisis, are really costly. They come with all sorts of political vetoes. They cost all sorts of political capital, and they take an awful lot of time. And so this is where we think speech also becomes important. Because yes, sometimes these governments will actually just reform their economies in response to these crises, but in other times, they will also use speech to try and manage the worst or most negative effects of these crises. And this is not necessarily new or extraordinary. And in fact, economists have been talking for the last 15 years about the centrality and the importance of central bankers and the speeches and the messages that central bankers give. And we know this, just the fact that everybody can interpret what the governor of the central bank can say in different ways, or someone from the Monetary Policy Committee makes a speech. Everybody can interpret that as being some sort of signal as to what they are going to do at the next MPC meeting. So we know, for example, Nicole Berg has a new book which talks about the importance of central bankers' communication. We know that they use different channels of communication. We know they actually talk to different sectors at different times, depending on the challenges the economy faced. And we also know that sometimes they adopt what might be called optimal obfuscation, where they don't want to give a clear message, and they give a message that's very hard actually to decipher, so no one can actually place their positions or get some sense of the signal that they're trying to send. And what we are suggesting in this paper is that presidents use speeches to manage the expectations of the market in a similar vein. So we think presidents probably use their speeches as a way to manage the expectations of the market in a similar vein. And we think they do this in two different ways. One is they highlight the saliency of different topics at different times. So they might talk about different topics when economic growth is positive and everything is normal, but when a crisis hits, because we think they now begin to try and signal to international economic actors that they might begin to highlight the saliency of certain topics to the detriment of others. And secondly, we think they might actually signal a different economic position when a crisis hits. So again, assuming that they are trying to speak to some type of international economic actor, we think this might motivate them to change their economic position that they are adopting within their speech. And so this leads to what I would say are less hypotheses and more sort of intuitive expectations, which is that when presidents are faced with international capital pressure, we think they will just devote more attention in their speeches to the economy. And likewise, when they are faced with these types of crisis events, we think they will adopt more market-oriented positions. So these are just two very simple expectations, and I think very intuitive expectations that are hardly that surprising to any of you. So how do we go about this? Well, we go about this by trying to examine their economic signal in their speeches. And of course, this is where things get a little bit noisy, and I'm not going to spend a ton of time, telling you how we do this. But what we want to try and do is do two things here. One, we want to try and establish what their economic signal is and the extent to which they change that signal in response to crises. The second is we want to try and identify what type of topics they talk about, and then whether they change the saliency of these topics depending on the context that they face in. So we have very simple intuitive expectations, and we want to try and explore this in a reasonably simple way also. So we use their annual presidential addresses to the legislature. Some of you will be familiar with these. In the US, of course, they're more commonly called the State of the Union Address. In Latin America, they have a lot of different names, but ultimately they take a similar type of format, which is a type of State of the Union. They're an institutionalized and annual political event. Generally, it's a moment or an opportunity for the executive and the incumbent to set out their political stall for the coming years, and they are usually addressing all the legislators, but they're not just speaking to the legislature. So early work that we have done, we explored the extent to which they speak to the legislature, but we also think they are probably speaking to other international economic actors as well. We think it's useful because it's a comparable data generating processes, and we think that presidents should or do reveal their economic preferences on the most salient issues during these particular speeches. So this is the text corpus. And these are the countries that we collected these speeches for. We also collected the speeches for Brazil, but we don't include Brazil in this paper simply because, and I'll show you next, we developed a dictionary, and so we wanted to keep everything in Spanish, so we just decided to drop Brazil for this exercise. The collection of this data itself was an incredibly time-consuming enterprise, and surprisingly so, and it took nearly about a year and a half, 2 years to collect all of these speeches. For some countries, it was remarkably quick and easy. So, I think for Peru, the speeches are all up online. We just downloaded them. It was done and dusted within half an hour. For others, we were in contact with National Archives. This is not our photo, by the way. This is a photo that appeared in the press, but just gives you some sense of the challenge that we faced. This is the National Library of Honduras. For example, we had people taking photos in National Archives and then sending them to us. And we had National Archives sending us books of old speeches, some of which I still have here in my office. But this is the final text corpus that we're using for this particular paper. And it's 280 State of the Union speeches in 12 countries. And we tried to go back as far as we feasibly could since the moment of redemocratization within these states up until the present day, which 2014 is an indication as to when we actually collected this data. So as I said, it's quite a long time ago. And we pre-processed all this text, remove accents, remove word stems, and all Spanish stop words. So I suppose the question then you might ask, well, does anybody listen? Do these speeches mean anything? So just in a very simple exercise, which is no clear evidence or proof that people do listen, but I think we think it's suggested that it is so. And what we did here is we took the Reuters, they have an archive of financial news, which I bet is 105,000 articles on financial news between October 2006 and November 2013. And we just created a dictionary with the president's name, the country's name, and message and presidential speech. And then we just simply used to try to find then all articles that mention these words, both a week before the speech and a week after the speech. What the top here shows us that this is coverage during years of what we call international capital pressure, and this is coverage during years where there is no international capital pressure. And what we find is that years where there is international capital pressure, on average, that the speeches are covered in about 17.8 articles. In years where there's no international capital pressure, speeches are covered about 13 times in a normal year. So for us, this is suggestive that, first of all, these speeches are covered and are considered by the news, but also that extra attention is devoted to these speeches in years where there is some type of economic crisis event. So how do we go about measuring these signals? Well, we want to do two things, as I said. We want to measure the economic signal, and we also want to measure the topics. And to do this became slightly complicated, and here I have to give full credit to Chris. This was a slightly complicated thing to do because obviously our speeches, they don't just talk about the economy. These are annual State of the Union addresses where they talk about all aspects of governance within that state. And they cover quite a wide array of topics. We obviously wanted just to isolate the economic signal. And traditionally, how people do this or have done this when they are scaling these types of speeches is they actually have to isolate and extract that economic portion from the text. And then they run some type of scaling model on top of these economic segments. And so Chris had the idea or the suggestion that we could automate this process. And we did this in 3 steps. The first is that we developed a dictionary using The Economist and the Manifestos Project, and Laver and Gary, they have a famous paper from 2000 where they have an economic dictionary. And then on the basis of a very small number of hand-coded speeches, we developed an algorithm which really tries to establish the optimal segment or the optimal area around some of these economic keywords that we identify. Because we are making the assumption here that presidents don't just say a sentence about the economy here and there, but they speak about the economy in coherent blocks, as this blue type of block here is supposed to represent. So for example, if this is a text string of length n, we then are looking for m hits within this text string, and then we are making the assumption that this length O is all the segments within that speech that are related to the economy. And so we have an algorithm that learns this optimal length of O. And so this enables us then to actually automatically extract those economic portions of the speeches from these texts. And then we run what's known as Wordfish, the scaling algorithm from John Slapin and Ollie Proksch, which is just basically based on word frequency or word usage, and assumes that words are distributed in a speech in a Poisson process. That is, that they are independent of other words. And we can talk a little bit about how sensible that assumption is. So we then use the scaling process of Slapin and Proksch, and this enables us then to generate this heat map, which is just effectively captures the different economic signals that Latin American presidents adopt over time across these 12 countries. And those that are darker in color are more to what we might call the left. Those that are lighter in color are more to what we might call the market or market-oriented positions. And again, intuitively looking, just eyeballing the data, it has a large amount of face validity. We can clearly see evidence for what we call the left turn, which is the electoral success of left-leaning presidents across the region, beginning in the 2000s, as we began to see rightist incumbents removed from office. And we can clearly see this, for example, with the Kirchneristas here in Argentina, but also as well with Hugo Chavez, and then subsequently with Nicolas Maduro in Venezuela. We are interested, of course, in not just these positions, because these positions aren't comparable across countries. They are comparable within countries, but not necessarily across countries, because obviously the types of things that we talk about are very different. And again, we can talk about this. But we are interested in the extent to which these presidents move, or the extent to which these presidents change their policy position. And so we are also observing the policy shift. So that is the extent to which the economic signal has shifted in a given year relative to the previous year. So the extent or the size of that shift. And what we can see here is that shifts to this side of the axis are shifts towards the market, on this side of the axis are shifts towards more state-oriented policies. What we can see is that actually Latin American presidents, although there's a general assumption that all presidents were just moving slowly to the right over time because of these economic pressures, at least in terms of rhetoric and the signals they send, well, they shift both to the right and they shift both to the left. But in the vast majority of cases, they don't really move at all, actually, and they're reasonably static in their position, which again is what you might anticipate. When it comes to the topic model, this is a topic model that we use from Robert Stewart and Tingley, and this allows just a mix of topics, what we call topical prevalence, and words for each topic, just topical content, to depend on certain covariates. And here we let topical prevalence covary with presidents, because we assume that each president has some type of idiosyncratic focus on specific topics over other. But we also let it covary with international crisis years. And so that is that years that are normal and years where there's some type of international capital pressure. This is just giving you an example. We have 34 topics in total. This just gives you some of the examples of the things they talk about. We find the most common topic is kind of a national development topic, which is all about developing the country. And there's a lot of talk about juvenile delinquency. We also have some idiosyncratic topics that are related to specific cases. So we have an economic development in Ecuador topic, which obviously doesn't apply to the other 11 countries in the region. but is idiosyncratic to the Ecuadorian case. But this just gives you some sense of the different topics that exist within these speeches. So now we are interested, of course, in exploring the dynamics of these economic signals. So now we've established what these economic signals, or at least we've come up with some reasonably reliable way, we think. I mean, there's problems, but there's always problems in how we establish these signals. And we have explored the different topics that these presidents address. And now we are interested in exploring some of the dynamics of these economic signals. So in order to do that, we explore the effect of credit market pressure and exchange market pressure on both the economic positions or the economic signals, or change in the economic signals, and also change in their topics. We just follow Dani Campello, who has a great paper exploring policy switches. She has a measure of exchange market pressure, and Barry Eichengreen before her, who also has a very good measure who also adopted, or was the first to adopt this measure of exchange market pressure. And this is just change in international reserves minus changes in the exchange rate, weighted by the standard deviation of both the reserves and exchange rate. And this gives us an index for exchange market pressure. And we just convert this to a dummy where this index goes above one standard deviation above the mean. So these are years where we think there are high levels of exchange market pressure, which are coded 1 and 0 otherwise. And we do a similar exercise for both credit market pressure, which takes bond-based lending and bank-based lending as percentage of GDP, and again, weighted by their standard deviations. And again, we use this index to construct a simple dummy. And if you're interested, I can send you the paper which talks about all of this in lots of detail. But what we then want to do is explore the extent to which these years of credit market pressure here, or exchange market pressure here, or both here, so these relatively small number of cases where we have got these types of years of international capital pressure, what does this do to both the topics and the signals that these presidents send? Well, first and foremost, this just shows you the shift in topic proportions. And again, it's not that shocking, or perhaps it's reasonably intuitive. What we can see is that topics related to social policy are downgraded. So presidents stop talking about social policy in years of international capital pressure. They begin to talk quite a lot about national development, or at least national development as it may be related to the development of the economy and to economic recovery. They talk an awful lot about government stabilization and government stabilizing the country and the economy, and about economic development. And again, education and economic production as it relates to the economy more generally. So we see some reasonable trends or expected trends that we might have anticipated to observe given these years of capital pressure and years of non-capital pressure. We also then just had a simple OLS regression. We include a number of control variables. And again, I mean, I can send you the paper if you're interested in the details of this, which just explores years of international capital pressure and the effect that this has in shifts on the economic signals within presidents in Latin America. And this is just a simulation. This graph just simulates those models. And what it shows us is that during years of international capital pressure, all presidents shift towards the market. So there's a clear and coherent and nearly homogeneous shift towards the market in years of international capital pressure. What we do find interesting is that the year after this capital pressure has subsided, there are quite different responses actually. And if we break it down by exchange market pressure, and if we then disaggregate credit market pressure even further by bond market pressure and bank market pressure, we can see different responses the year after these crises have dissipated. So the year after, or once these exchange market pressure crises have dissipated, well, actually presidents don't really switch back to the status quo or to their previous preference. They continue signaling to the market even a year after these exchange market pressure crises. But in contrast, when it comes to credit market crises, either bank or bond-based pressure, well, once these crises are over and we assume that these governments have access to credit once again, this gives them the freedom to return to their previous position or to their preferred position or to the status quo, and they tend to switch back towards the market or towards the more state-oriented policies in these years following these crisis events. We don't really have an explanation for this. We're not quite sure why this is. We think probably the answer lies with the work of Stephen Kaplan, who's tried to disaggregate between bond-based crises and bank-based crises. But we think it possibly has something to do with the type of creditor and the type of crises that these governments face. But nonetheless, there is some evidence, or at least tentative evidence, that these governments adopt different signals even after these crises have passed, and that something happens during the course of these crises that shapes the durability and longevity of these signals. And as I said, we don't really have an answer as to why that is. So suggestions would be more than that. So then just to finish off, because I realize I'm just gone over time. So, I mean, what I suppose if we were to make any major claim here is that we think rhetoric is a really key tool of risk management, or it seems to be a key tool of risk management within these economies. Our results are very noisy. We don't have a huge amount of speeches. Some of you probably use big data and can't believe that we're using 208 speeches. So the results are quite noisy, but we think they are reasonably suggestive. Of course, what's important then is to whether, if governments, so what we have shown here is that not necessarily that governments are managing capital expectations, but what we are just showing is one small part of that overall story, which is that governments definitely respond. Presidents do seem to respond in the signals that they send through their speech to different types of international economic dynamics. But as to whether or not these signals have any type of subsequent effect, I have no idea. So whether, for example, if they make these signals, does it then have an effect in stabilizing the economy? Does it then mean that they do gain access to credit that might be cheaper than other years? I can't answer that. Intuitively, I would say maybe, perhaps, but I really don't know. And I think what's probably important as well is that while a lot of work has actually focused on substantive shifts, so actual observable shifts in policy, what this suggests is that presidents can signal policy shifts even before such shifts actually take place, or even if they ever take place. So presidents can signal that they're going to do X or Y or Z with regards to the economy in an attempt to placate capital. Whether they actually do that or not, of course, again, is a question that I don't have an answer to. And of course, kind of the wider implications of this is that this probably has implications for accountability and for governance. These are countries where, as I said, spatial voting is very weak. These are countries that have had all sorts of issues with representation and with policy switching. And the types of dynamics that we're talking about here, where presidents do change their signals according to these international market events, we think that this can have quite significant issues for these types of processes of representation and accountability. And finally, we don't think, of course, that this is necessarily unique to Latin America. We suspect that this is a dynamic that probably happens all over the world. One of the things we do want to highlight is that we think that this dynamic might be magnified to an extent in Latin America, just simply because of the dependence that these economies find them. It's a structural dependence that they find themselves in with regards to the international economy. And that's it. Thank you.